When we covered adjusting entries in Unit 4, we went over depreciation. We will now continue that discussion. As we mentioned, when we buy an asset such as a vehicle or a machine, we record it as an asset. We call that a tangible long-term asset. Over time, the asset will lose its value due to use and wear and tear, and we need to have an accounting way to show that usage as an expense over the life of the asset. We call this process depreciation. There are several ways to compute depreciation. In this course, we will cover one of the techniques, straight line depreciation. For example, we buy a truck for $26,000. We expect it to last for 4 years. At the end of 4 years, we estimate it will have a value of $2,000. This is often called the residual value. Initially, we record the truck as an asset with a debit to the asset vehicle and a credit to cash if we paid for it in cash. We then post the transaction to the ledger accounts with a debit to vehicle and a credit to cash. However, over the life of the vehicle, we need to transfer a portion of the cost of the truck into expense. This matches the expense of the truck with the revenue it produces for each of the 4 years we anticipate it having value. In regard to depreciation, as I mentioned, there are several ways to do the computation. In this course, we will use the simplest, straight line depreciation. After 4 years, we want to be left with the residual value of $2,000. That means that we need to move $24,000 of the cost, $26,000 minus $2,000, into expense. $24,000 divided by 4 years equals $6,000 depreciation expense per year. Using straight line depreciation, we spread this amount over the 4 years we expect the truck will last. In so doing, we meet the matching principle of accounting, wherein we get the expense in the same year as the revenue that the asset generated. Recording depreciation is an adjusting entry. It does not involve cash. Depreciation is known as a non-cash expense. We want to keep the asset account at its original cost. Therefore, we set up a contra asset called accumulated depreciation. As I previously mentioned in this course, a contra asset account is an asset account which is expected to have a credit balance, which is contrary to the normal debit balance of an asset. A contra asset account is related directly to another asset account. In this case, the contra asset accumulated depreciation is directly related to the vehicle account. When I record my depreciation expense for the year, I would debit depreciation expense for $6,000 and credit accumulated depreciation for $6,000. I would then post the transaction to the ledger accounts with a $6,000 debit going to depreciation expense and the $6,000 credit going to accumulated depreciation. Remember, accumulated depreciation is a contra asset account. I now want to define what is known as book value. Book value is the tangible long-term asset's cost minus its accumulated depreciation. For example, after 1 year, the vehicle we have been using in this example would have a book value of $20,000. The $26,000 cost minus the accumulated depreciation after 1 year of $6,000. After 2 years, the vehicle would have a book value of $14,000 because now we have accumulated 2 years depreciation. After 3 years, the vehicle would have a book value of $8,000 because now we have accumulated 3 years of depreciation. And finally, after 4 years, the vehicle would have a book value of $2,000 because now we have accumulated 4 years of depreciation. We would stop depreciation here because that is what we estimated the life of the vehicle to be. It would remain on the books with a book value of $2,000 until we get rid of it. At the end of the first year in the financial statements, we would show the vehicle at a book value of $20,000, $26,000 minus $6,000 on the balance sheet. The depreciation expense of $6,000 is shown on the income statement as an expense. When we dispose of a tangible long-term asset, we need to make an accounting entry recording the disposal. In many cases, we sell the asset to someone else. What we need to do is record the cash we receive and then clear the asset and its contra asset accumulated depreciation off the books. Often, this results in a gain or loss. Here's an example. After 1 year, we sell our vehicle for $22,000. What I usually start with is the cash. I know that is a debit to cash. Therefore, I debit cash for $22,000. I know I no longer own the vehicle, so I must clear it out with a credit of $26,000. I must also clear out the contra asset accumulated depreciation, which is $6,000. The difference is a $2,000 gain on the sale of the vehicle. This is income and will show up on the income statement as revenue. If it was a debit, it would be a loss on the sale of vehicle and be an expense. After the recording of the journal entry, I would post the amounts to the ledger. Remember, the gain on sale of a vehicle account is a revenue account. We also introduce the concept of intangible long-term assets at this time. Intangible assets are long-term assets that lack physical substance. A good example is a patent. A patent is an exclusive right granted by the federal government for 20 years for a new product or invention. Typically, it is given to the person or company who invented something. Let's say you invent something and get a 20-year patent on it. Then you sell it with 8 years remaining to ABC Company. ABC Company would record the intangible asset called patent by debiting the patent account for what they paid for it, say $32,000, and crediting cash. The entry is then posted to the ledger accounts. The cost of an intangible asset is allocated to expense over the life of the asset through a process known as amortization. In this case, we have an intangible asset patent that costs $32,000 and has an 8-year life. We use the straight line approach and divide the cost by the life, $32,000 divided by 8 years, to compute $4,000 amortization expense per year. The accounting entry is a credit to the accumulated amortization account and a debit to amortization expense. As always, the journal entry is then posted to the ledger accounts.